Hi everyone, welcome to our webinar on protecting your business from a potential downturn. My name is Sian, McLachlan and I am a practice leader in LegalVision's corporate transactions team. I'm joined today by our co-host from HLB Mann Judd, James Macfarlane, who is HLB Mann Judd's Director of Debt Advisory, and Tom Roberts, HLB Mann Judd's Director of Business Advisory. Before we begin, a couple of quick housekeeping items. So first of all, you'll be emailed the webinar recording and slides after the webinar to the email that you've registered with. Secondly, we'd love it if during the webinar you could submit questions, any questions you have in the chat box down the bottom right. We'll be doing a Q&A after we present to answer any questions you may have. And lastly, we would be grateful if you could please complete the survey after the webinar of any feedback you might have on the content and the presentation you've heard today. We would also like to let you know that all attendees are eligible to receive a complimentary consultation with LegalVision to discuss how we can help you with your contracts or any of your legal needs. So to request your free consultation, please provide us with your contact details in the survey that appears at the end of this webinar. So today we will be discussing, first up, the process of reviewing contracts. Secondly, reviewing financial arrangements, then renegotiating contracts. Then next, Tom will take us steps to take during economic uncertainty. And lastly, James will talk about the impact of interest rates on your business and some steps that you can take to combat that. And then finally, we'll finish up with the Q&A. So firstly, I will be talking about the steps you can take from a legal perspective to protect your business from a financial downturn. So the first step is to review your contracts. And the contracts you'll want to be focusing on here are the contracts for your main revenue streams or your main assets. So these are most likely your customer contracts or your service contracts. Or if you're a different kind of business, maybe you're a wholesaler or distributor, it might be those relevant contracts. So either your wholesaler agreement or your distribution agreement. So the first step is to check that those contracts exist. So either going through your emails and finding a copy of it, or you might have a hard copy of the contract somewhere. So once you've located a copy of the contract, the next step, step 2, is to make sure that the contract is signed. So the contract, to be enforceable, to ensure that you either have the right to that asset or the right to that revenue stream, needs to be enforceable. And so to do that, it needs to be signed by all parties, so not just yourself. So sometimes we have clients that come to us with their contract and they only have the counterparts that sign by themselves, and we ask where the other copy is, and they go through their emails and they find the other party has never signed. So make sure you go through, make sure the party has signed. Or it might be maybe you've got some online T's and C's that maybe someone signs up to as part of the process for that service. And so maybe they tick a box to agree to those terms and conditions. So making sure you have a record of that somewhere. The next step, so step 3, is to make sure that that contract or those terms are effective. And what you're going to be looking for here is to see whether or not they're still ongoing. So firstly, check if there's a term to the contract. So some contracts only go for a fixed term, maybe 1 year, maybe 4 years. So going and looking at the term of that contract and making sure that it's still ongoing. The next step is to check that it's not being terminated. So you're going to be looking here at the termination clause in your contract. So most contracts require both parties to agree to terminate the contract. Sometimes it might be that the other party has a right to terminate in certain circumstances. Usually they have to provide notice to the other party. So if you've not received notice that the contract is terminated, hopefully, and you've not missed the notice, hopefully it should still be on foot and your terms should be your contract should be enforceable. And you should have comfort that if you need to, if your customers don't pay you or there's some issue, you can enforce your contract to recoup those monies from your customers. So those are the contracts for your main assets and your revenue, but you might have, in connection with those, taken security. So this might be say you've sold goods to customers on consignment, you might have taken security over those goods. Or if you're a lender, you might have taken security over some assets of the borrower. Or potentially if you've sold a business, you might have provided some financing and taken security over the assets of that business. So you're going to want to know if your security is enforceable. So like I've talked about the steps for ensuring a regular contract is enforceable, you're going to be going through checking you've got a contract of the security agreement, or if the security agreement's in another agreement, maybe it's in your existing terms and conditions that's been signed. Again, that it's not been terminated. And then lastly, you need to check that the security has been registered. So in Australia, all security over personal property, anything that's not land, needs to be registered on the Personal Property and Securities Register in order to be effective. So what I would suggest is, if you think you have taken security, is going on to the PPSR, that's the acronym, and doing a search against assuming you've taken security over the company's ACN. So unfortunately, if you've made the registration against the company's ABN, even if unless it's acting as trustee of a trust, that registration's not going to be effective. Similarly, if you've made the registration against the name of the company, also not effective, not perfected, I should say. So you need to be searching against the company's ACN and making sure that you can see your registration listed there. If you don't see it listed there, what you need to do is register immediately, but just take note that your registration will be subject to a 6-month vesting risk. So what that means is the person who's granted you the security, so maybe your customer, maybe your borrower, if they go insolvent in the next 6 months, that registration won't have been perfected, so you won't have priority status to those assets. But once the 6-month period has passed, then your registration will be perfected and you'll be able to enforce your security as you hope to. I just want to draw out here something really important. So enforceable contracts are important not just in the day-to-day running of your business, but also if you're thinking about selling your business, which I know a lot of clients are doing at this time. So as a buyer is going to be conducting due diligence on your business, and as part of that, they're going to be looking to see if you've got contracts in place that secure your main revenue streams. So really, really important to check that, again, that you've got those enforceable contracts in place. That's a huge step. Next, I'm going to be talking about reviewing. So we've talked about your contracts for your assets and your revenue. Now I'm going to be talking about your contracts for your financial arrangements you might have in place. Maybe it's a loan, maybe it's a safe or a convertible note. So first step is to go through those contracts. There's kind of two things, main things I want you to be looking at in those ones. So first is the representations and warranties you give under that contract. So you give a whole lots of representations and warranties about your financial status, about the enforceabilities of the contracts, things like this. So looking through those representations and warranties and checking that they're all still correct. Because it's important to note, you don't just usually give those representations and warranties on the date of the contract. Usually they are deemed to be repeated throughout the life of the contract. So even if you don't think you can give them, you're deemed to have given them. So you need to review that list, and if there's anything that you think that you can't, that is no longer true or is misleading, you need to be having a conversation with your counterparty, your lender, whoever it may be, and having a discussion with them and potentially obtaining a breach from that waiver and potentially renegotiating it if you think it's going to be an ongoing source of an issue for your company. The next thing I want you to look at is your financial covenants. So these are often in lending contracts, and James's team actually specialize in helping businesses determine what financial covenants might be appropriate for their business when they're entering into lending arrangements. So financial covenants are promises that you make generally to your lender about the performance of the business or how you think it will perform. So these might include cash covenants, debt covenants, revenue covenants. So please review those, because especially in those times when businesses are hitting tough times, those are the things that can start being in breach, and it's best to have upfront conversations with your lender to let them know if you are going to be breaching those covenants, and trying to negotiate a workaround with your lender. Lastly, a contract that some people don't often think of a contract, but it's your constitution, which is the contract you have with all of your shareholders. And the reason I want to draw your attention to this today is to kind of think about it in the context of payments that you might need to make to preference shareholders. So as a founder, you might have raised money, congratulations. You might have done that by issuing preference shares to investors. So those investors are going to get paid in preference to you. That's what a preference share generally means. So if you think about that, that means that preference shareholders are in a way incentivized to liquidate your company as it starts to decline in value, which can happen during a downturn. And so what you need to be doing is having a look at your constitution, looking at the liquidation preference of those shareholders, determine, you know, if I were to liquidate the company today, what would I have to pay those people? Do I have enough to pay out of whatever I have on offer at the moment? If you don't, or if you think there could be issues there, have upfront conversations with your shareholders. You need them to buy into the long-term strategy of your business. You need to convince them, you know, even though that, you know, we're in a bumpy time at the moment, I've got a vision. I know how we're going to get the company back on track and increase its value. So you're trying to dissuade them from taking steps to liquidating your company. That's it from me on the legal side. I'm now going to turn to Tom, who is going to give you some practical steps of things you can do, look out for with your business during a downturn. Thanks, Tom. Oh, sorry, before we jump to Tom, I'm just going to take a step back. Just quickly going to go through renegotiating your contracts. So we've talked about reviewing your contracts. So next, the process for renegotiating your contract. So if there have been any issues based on the reviews that we've picked up with, the next step is to renegotiate your contracts. So first step here is checking the process for amending your contracts. So usually it requires agreement of both parties. Sometimes a party can amend it unilaterally, I should say. So go and have a look at your amendment clause, check who can amend it, and then have a conversation with your counterparty to try and get it amended if it needs to be. On your receivables, you might looking to amend the terms so people pay earlier. As a borrower, if you've borrowed money, you might be looking at a number of things. So first is you might negotiate an extension for when your principal is due. So you might be obliged to make monthly payments of principal. You might look for an extension of that date. So say, I'm not going to pay principal for the next 6 months. Can I pay at a later date? And your lender might say that's okay. The next is to revisit your undertaking. So maybe you've made undertakings not to sell certain assets, but at this time you might need to realize those assets to get some cash into your business. So have a look at those and maybe renegotiate those. The next is you might seek a break from monthly interest. So similar to principal, you might defer interest payments for a few months. So interest might still accrue from this period during this period, but you don't have to pay outlaying the cash maybe for a few months. Next is renegotiating the events that lead to default. So looking through your contract, seeing what triggers an event of default. If any of those are an issue, then having a conversation with your lender. So similar to the financial covenant point, having a conversation with your lender and trying to renegotiate those, or at least seeking a breach from that event, seeking a waiver from that breach of event of default for a period until you get your business back on track. Now I am going to throw to Tom, who is going to run you through some practical steps you can take at this time. Thanks, Tom.
Thanks, Sian. So look, I understand that most of the people on the webinar today are business owners. So I wanted to use the time we have just to give everyone some practical tips and share a few stories of how best to navigate economic downturn and all the uncertainty that comes with it. So I'll go into more detail throughout the presentation, but to start off, I think what you can see there on screen really is a high-level overview of the steps you should be thinking about. So I think to start off, the first thing is really taking stock of your current position so you can see where you're at, and then going through a process to identify all of the possible alternatives, including the worst case scenario and what that might look like. So when you're going through that process, I think one thing that's often overlooked is it's really important to know yourself as the leader of the business and how you react to adversity. So do you show signs of stress? What type of message are you sending to the team and external stakeholders? What type of decision maker are you? And what information do you need to see to help make decisions, etc. You know, just thinking through those types of things and understanding you and your decision process to, you know, just to help navigate that. that process. So I think, you know, that'll give you that'll help you understand your starting point. And then as you move forward, I think to navigate things, it's really important to then identify and monitor the key metrics of the business on a regular basis. So I think the key there is really simple, quality and regular reporting coming through to you as the leader of the business. And then as you get that information, it's then up to you in terms of how you respond accordingly and making sure you're refining your approach as you go along as well. So hopefully you're able to get the situation under control pretty quickly, and then it's a case of then looking for any opportunities along the way, which I'll speak about a bit later. So at a very high level there, that's the sort of framework, and now I'll sort of dive into a bit more detail. So in terms of, I suppose, how to take stock of the situation, I think the first one that we've got there on screen, looking at your monthly burn rate for the business. So that's, and I think tying in with that is what are the possible outcomes. So when you're looking at possible outcomes, I think there's probably three. So again, just being upfront and looking at what the worst case scenario might be. So, you know, that could be, I don't know, say demand falls away, and we could be looking at a situation, worst case might be we're looking at a situation where we lose 50% of revenue, say. So I think, you know, trying to figure out what your monthly burn rate is. So that's having a very good understanding of your fixed cost versus your variable cost. So you might know paying rent and myself and skeleton staff and all the people that are required to keep the business running, you know, say that's 100,000 a month, and then you've got your variable costs. So knowing what your worst case looks like, you know, you might figure out, okay, I need 200,000 a month to keep the lights on. So then the last step there, which we've got there, is then figuring out your runway. So what we mean by that is, so if you've got, say you've got $1 million of working capital in the business to fund, and you know that under worst case I've got 200,000 a month, that means I've got 5 months of runway to navigate this situation essentially. So I think, you know, just taking stock, you really just want to put all the cards on the table and look at, as I said, worst case scenario, what does business as usual look like and how much runway do I have there? And then also the midpoint of those two is generally what we sort of recommend to clients. So as a starting point, just being upfront, confronting the situation and putting all those cards on the table, as I said, to give yourself a bit of comfort about, you know, what am I looking at? So in terms of, I suppose, just the next slide, so what you should be monitoring. So once you know sort of where you are, I think what should you be monitoring as you go along? So all those things you see there on screen. I think cash flow is obviously hugely important. So again, understanding your fixed costs. Is there any collection risk with your clients? Is there anyone of your clients that you're thinking, you know, there was a story recently of an accounting firm, and they were suing one of their clients because they had 3 years of outstanding debtors. And you know, my first thought is, well, how did you let it get to that point? So I think just monitoring your client base and sort of assessing whether there is any collection risk. Is there any source of available funding? So, you know, whether that's the owners putting more money in. If you're a startup, can I do another capital raise? Do I have debt facilities? Even just considering should I look at an asset sale, for example? So, you know, can I sell anything to release cash if I need to? Obviously, tying in with your cash flow, then you've got forecasts. So I think just again, having those three scenarios: worst case, business as usual, and then the midpoint of the two, which is most likely where you will land. So I think just looking at it on those three things, but just a bit of practical advice. I think keep it simple and don't overwhelm yourself. Like, you know, I've seen a lot of clients that try and look at forecasts, and you know, they try and sort of reconcile everything to the nth degree. But I think just it can be high level, and just keeping it simple. It's better to have something than to overwhelm yourself and not do anything. So just, I think, as I said, worst case, it could be just 50%. So making an assumption and then looking at it at a high level it doesn't need to be perfect, I guess is what I'm trying to say. Then I think, you know, just looking at monitoring your demand and lead indicators. So that's a really important one. As a business owner, do you know the key drivers of demand and how they're changing? And do you know, are you capturing that data? So, you know, one client I work with, they're in construction, and their whole business is built on competitive tender. So, you know, we started basically building a report for them that monitored all of their tendering activities. And really what that enabled them to do, going back a few years, they could see there was a downturn coming in their core market, because there was about a 12-month lag between when they do a tender to when they start work. So by actually monitoring the tenders as a lead indicator of revenue, they could see there was a big downturn coming in their core sector, and they were able to sort of get a bit more aggressive on pricing to secure some work, and then also sort of win some work in other areas to make sure that when that downturn did come, they probably saw that 3-4 months before their competitors, in which time they had secured quite a lot of work. And then when that downturn inevitably hit, they were pretty well placed and able to sort of, you know, because they had responded accordingly, they were able to take a bit of market share and protect their position. So I think just, you know, mapping that out and understanding, you know, the more you can understand around that, that can be a real competitive advantage, particularly in times of downturn. So in terms of clients, I think, you know, just how are their needs changing? Sian spoke earlier about knowing your contracts. I think that's really important. You know, just literally a week or two ago, I had another client that basically one of their clients went bust and they were in the hole for quite a bit of money. So, but luckily they'd sort of preemptively had reviewed the contracts and things and were able to take some practical steps. They were acting as a subcontractor on this job, and they were able to go to the principal, and under the terms of those contract the developer was able to cancel the contract with the principal contractor, and our client was able to take over as the principal contractor. So I think Sian's advice is very sage, knowing the contract and what you can do in down periods. And also I think just practically, just whether you're overly reliant on any key clients, and if there's any risk of default, you know, the more you can sort of assess if you're doing 40% of the revenue from one client, say, then, you know, what safeguards can you put in place, and, you know, do you have a plan if something were to happen with them? In terms of team engagement, I think, you know, that's really important as well, making sure that you're keeping your finger on the pulse. Culture is key, and I think, you know, one thing I've seen with a lot of my clients as well is just a bit of a recognition of, you know, in times of downturn, that the staff are doing it pretty tough too, and as leaders of the business, you know, they're looking for reassurance. So I think it's just being realistic and making sure that you're communicating regularly with your team and being realistic with them as well. In terms of your supply chain, so again, looking, you know, I've just said look at clients, also looking at supply chain and key partners. So who are we relying on? Are they financially strong? Do they pose any operational risk to us? And is there any steps we can take to mitigate that? So again, another quick story. We were working with another business, and they were quite reliant on pipe supply. And basically they sort of found out that there's 3 major suppliers in Australia, and one of them went under, Rockler. I don't know if anyone sort of saw that. It's pretty sort of hit the news, but so Rockler went out, and that really ruined the supply of piping across Australia. And a lot of the developers, it blew out to, there's like a 10-month wait on piping. So, you know, we were working with one party that could sort of see that coming, and preemptively took steps to basically secure. They stockpiled quite a lot of supply, probably well more than they needed, to just navigate that situation. And then actually what happened when they sort of went under and times got a bit tougher, they were actually able to then on-sell some of that supply to other competitors at a premium, which sort of released a bit of cash for them, but also meant that all their projects weren't delayed, and they were able to keep running pretty strongly. So again, just monitoring your supply chain and key partners. And then just those last 2 points there. So your other key operational metrics, just making sure you know what the drivers of production and output are. You're looking at ways, can you be more efficient? Is there anything you can cut out if times get tough? And then last of all, your debt covenants, which I know James is going to talk about a bit later, so I won't labour on that. So again, they're at a high level, I suppose, what you should be monitoring. And then just to sort of finish off, wanted to give some practical tips. So again, just a bit of a summary. I think, look, from our perspective, when we see clients in these sort of situations, I think first and foremost, quality reporting is crucial. Making sure, you know, you've got forecasts. I think, you know, having the mantra of prepare for the worst, but hope for the best. You know, I shared that tender example earlier, and I think that's a really good example of, you know, making sure you're getting that information. I think being prepared to play defense for a period of time as well. So, you know, if times do get tough, make sure that you're sort of prepared for that, and you can take it back to basics. So go through, identify any sort of nice to haves or non-essentials in the business, and know what steps you're going to take ahead of time is really important. You don't want to be scrambling when the tough times hit. So just making sure you confront those brutal facts and you have a plan to protect your position. Communicating regularly, that's hugely important. The worst thing you can do is put your head in the sand. I think just identifying who your key stakeholders are, so your clients, your team, your lenders, and making sure that you're touching base with them on a regular basis to manage their expectations. And I think, as I said, knowing yourself is really important, but I think just that point we have there, make sure you're remaining calm and try to systemize your approach. So again, you standardize your reporting, surround yourself with the right people, review the situation regularly, and act decisively. So when COVID hit, just to give you another quick story, when COVID hit with us, for example, as a business, we had a bit of a response team that was meeting twice weekly. So again, just to sort of monitor the cash position, monitor how our clients doing, and they were getting an information flow, and they were meeting twice weekly just to monitor and make decisions quickly. So I think the more you can systemize and systemize that approach to management decision making, I think the better placed you're going to be. So as I said, if you do all that, hopefully you're in a pretty good position. I think just the other point there is just making sure you're looking for opportunities along the way as well. So if you are financially strong and you're stable, once you've sort of responded to the environment, there's heaps of opportunities. Like Sian said earlier, people are selling, and that's true. There's a lot of, or even people sort of hitting trouble and looking at insolvency and things. There can be opportunities for opportunistic acquisitions. We're even working with one business, for example, where the financiers now, so they're sort of in sort of construction based as well, and the financiers now that put up the guarantees for the work, they're actually getting involved and saying, no, you can't use that subcontractor, or you can't use this person because they've got ATO debt or they're not financially viable. So our client's quite financially strong, so it's actually playing to their hand, because now the financiers are actually telling the end landowner that, hey, you can't use these businesses because they're not strong enough. So I think just looking, there are opportunities amongst all the chaos, and making sure that you're keeping an eye for that. And then last of all, I think just making sure if you need help that you ask for it. A lot of business owners, in my experience, and I'm sure the other panelists, you can be very, very proud. So don't be afraid if you do hit tough times to ask for help, because there's a lot of help out there, and a lot of people that might be able to take the blinkers off and help. So I think that's the last tip I was going to offer. So that's it. Now I think we're going to hand over to James, who's going to talk through the debt side of things.
Thanks, Tom, and thanks, Sian. So we've all seen interest rates rise. So they've gone up 3.5% in a little over 10 months now. And to place that into context, that's probably the largest and quickest rise of rates that we've seen since the 1980s and Mr. Keating's recession we had to have. So that's a long time ago. So whilst rates were certainly very low when this rate cycle of increases started, the quantum and the speed of this change is having an impact. And even my top borrowers, so very strong credit borrowers, who were back in April last year paying well under 2% for their money, they've seen that go into the low fives, and you do that as a multiplier effect, it's nearly 3 times the actual quantum of interest cost that they're paying. So that's a good borrower, and if you're up a scale a bit, then that factor can be a little bit more. Now I know market pundits, interest rate market pundits, are sort of saying that we've still got very low rates historically, which generally we do, but when you have that impact in a short period of time, I don't think anyone really felt that we would have interest rate rises of 3.5%. I didn't, and a lot of my customers didn't. So were you planning for that? Maybe, but probably likely not. So that's having an impact, I do believe, but it's also, you've got a 7% inflation rate at the moment, which has a double impact. So you're getting hit not just from your lenders, you're getting hit from all other parts of your business as well. What's also happening is, likely now versus 11 months ago, the amount that you could actually borrow if all things stayed the same has actually fallen. So if you get a bit stuck, the ability for you then to reborrow or restructure something somewhere else with higher debt is actually harder. So, so that has a play as well. And then interestingly, conversely, the rate rises have actually had a positive impact on the lending and banking sector, because when rates go up, it actually positively impacts bank profits in the very short term. So all our banks are actually are very strong at the moment. They're making good profits. Their net margins have actually widened through the last sort of several months. So they still have a very good appetite to lend. And good, well-structured loans are still being highly sought after by the banks. So we've got this interesting situation where people are reassessing. The banks are still keen to lend, but they're also a little bit wary, because we are, as Tom touched on, we've seen some collapses particularly in the construction sector. So, you know, they are a little bit wary as well. Now with the rate rises, probably the greatest impact it's had certainly on my customers, and also, you know, if you have loans in place where there are covenants, that you have had to have covenants on your loan structures, it's those servicing structured covenants that have really been impacted. And look, in reality, I've been working with my customers probably since October last year, that if we felt those rates were still going up, which they ended up doing so, we started talking to the banks at that time, or their banks, and renegotiating those covenants, because it is important that you do that, because if you do breach a covenant, the control and power it gives to your lender is quite significant. It basically allows them to restructure and call up your loan, even at the worst case, within a set periods of time. That's the worst case, but it does give them a lot of power to change price, to change terms, and to, worst case, call up the loan. So they are things to manage. They're not just there, for a what if. They are things that you do need to manage. And due to those changes in rates, I'm also seeing that when rates increase in the market, it basically gives a more margin to the banks, and I'm seeing a minimum 0.5% difference in, let's call it a loyalty tax, where if you were to reset that deal, whatever it is, whether it's a business or a mortgage loan, in the market today, there's at least another 0.5% that's been built in. So in context of everything that's happening, I do believe it's imperative that today you review your finance dealings, your contracts, the cost, and everything that surrounds it. Because I do believe, as a minimum, if everything is going well, you can save some money, because there is some built-in extra margin that I do believe often comes in these times. But as a worst case, you should be in a much better position, or give yourself comfort that you are in a sound position in any case. Now, Debt Advisor, we live in this space. It's what we do. We know how to approach banks. If you are thinking that you may be breaching covenants and you're nervous about how to approach that, we are the people that are independent. We're on your side, and we can be the people you have those difficult conversations with. Even if you want to have that conversation with your bank and not us, you can be the one. We can be the ones that you try that out on. So it's not an easy time, and renegotiating covenants can take 3 months to achieve and to implement. So the quicker you do it, the better you're off. That's all for me.
Great, thank you, James. Thank you so much for that. That concludes the main part of our webinar. You might find our publications useful, so please try and download. We've got 6 steps to surviving a potential downturn, and a loan repayment options during a downturn fact sheet. So they can be accessed in the handout section of the webinar panel, which should be just to your right. We also have an upcoming event that may be of interest to you on managing employee sickness and absence on Thursday, the 27th of April, Australian Eastern Standard Time. You can register screen. So we will answer your questions very shortly. So if you have a question and haven't submitted it already, please take the time to do so now. While you are submitting your questions, we'll take a minute to tell you about the membership we offer at LegalVision and also how to contact HLB Mann Judd. So just quickly, LegalVision's membership is a cost-effective alternative to the expensive hourly rates you experience with other law firms. So for an affordable monthly fee, you receive cost certainty and all-inclusive legal services, including unlimited document review, including drafting, amending and reviewing of business contracts and commercial leases. It includes unlimited advice consultations with our team of more than 100 specialist lawyers, including business structuring, employment disputes and more, and unlimited domestic trademark registration. So LegalVision's membership is like having your own in-house counsel. We'll take care of all your business as usual legal work so you can focus on running your business. And if you are an in-house counsel, our membership is a cost-effective solution for outsourcing additional legal work. To learn more about how membership can help you, please request a free consultation when the survey appears at the end of this webinar. And James and Tom, who have spoken today, would welcome assisting you with any accounting related questions you have off the back of today's webinar, or any steps you would like to take with regards to restructuring any financing arrangements you have in place. Their contact details can be seen on the screen here. We'll also be including them in the post-webinar email when we send you a recording of this webinar and other resources. So we will now answer some of your questions. So first up, I run a startup business, but we do not have any clients yet. Will this affect how I should protect my business from a potential downturn? Tom, are you happy to answer this one?
Oh, yeah, absolutely. Okay, so no clients. I think probably the first thing to say is in times of downturn, probably the other thing is funding. Probably funding can get a little bit tighter. So I think it's just a case of really trying to understand what I spoke about at the beginning. What's your burn rate and what's your runway? So I've got X amount of funding. I'm not turning revenue yet. How long can I last, or do I need to? I suppose how much money you've got. Say you've got, I don't know, $1 million of funding. You might need $200,000 of R&D. Say, then how long have I got? How long till I can turn revenue, and do I have alternative sources of funding available? And also, if you can't get alternative sources of funding, I think again just confronting those brutal facts and sort of making sure, do you have an exit plan in place if it does? So I think during downturn, I think again it's just being realistic that funding can get a little tighter, and just making sure that you're very aware of how much money is going out the door and how long you have to sort of navigate that situation. I think would be the key steps I'd be recommending.
Thanks, Tom. The next question is, will it still be possible to find investors for fintech? Interesting question, I guess, especially considering everything you read in the papers. I think it's easy to get the impression that the VC markets have completely dried up. That's definitely not the experience that what I'm seeing on my end. Certainly there are still investors out there. I think, just like James talked about on the lending side, people are still willing to invest or fund. They're just being a little bit more savvy about it. So certainly, if you are looking for investment, in terms of like making contact with investors, the VC funds put on plenty of panel events that you can attend, and that's a great way to connect. And, even if you're not looking for VC funding at those events, there are often many, many angel investors there, or alumni as well. I know StartMate just ran its biggest demo day ever with, huge attendance by a number of people. So I would say, don't be disheartened. There are definitely still people out there looking to invest, although it may be a little bit more competitive. And I think when it comes to funding, certainly people are being a little bit more savvy in the way that they approach things and asking for some different things in terms of documentation. but certainly those investors are still there. The next question we have is, we are an agro-allied processing company. How can we get foreign partnerships and loans? James, I'm not sure if you might be able to answer this, or if not, maybe you can speak more, you know, in terms of the process about taking out a loan and your experience with that.
Sure. Agro-allied processing company, I assume it's someone that is in the processing of things, whether it be food or other items. So foreign partnership is one part and loans is another. I think they both come into play when you have to be able to tell your story.
All tones and sirens.
Is that ours? Is that
all tones and sirens? This.
Okay? I had a cross purpose there, but we you have to be able to go to market, whether it be a foreign partner or a lender, and you have to be able to tell your story, both from a financial perspective and from a background perspective. So partnership, lender related, I think the story can be quite similar. You do then have to target it somewhat differently depending on who you're approaching, but you have to be able to get that story down on paper. Thanks.
Thank you, James. Oh, I'm just going to file. I might throw to Tom to wrap up. Sorry.
That's all right. Well, so I'm assuming if there's no other questions, thank you everyone for joining us. So at the end, as you see on the screen there, a survey will pop up. So it's very, very short. So it's good to get your feedback so that, you know, LegalVision and us at HLB can help sort of offer more useful information going forward, I guess. So and that complimentary consultation that Sian spoke about earlier, if you would like that, please put your contact details in there. So thank you everyone for joining us.
Okay. Thanks, guys.